Well, welcome to the Ash, Hubert, and Kevin podcast. We're here trying to help the finance and companies go through transformations and assist them through areas of focus. So, my name's Ash. I am a chartered accountant by trade. I hold an MBA and I've also got a GAICD. I'll next pass you over to Kevin.
Yeah, so I am a CA, finance leader, worked in multiple disciplines and corporate functions. Love championing Aussie business. And Hubert is in his home in the warm weather with a beanie on and a Wednesday League shirt on. Hubert, CA, what else do you have?
Yeah, so I'm a chartered accountant. I've finished a Bachelor of Business and also Master of Finance. Been an accountant for 10 years, auditor for another 10 years. And yeah, that's my experience.
Nice. Well, thank you,
Nice.
guys. Well, today's episode is going to be about navigating economic downturns. So, let me set some stories. We're going to go back in time to COVID-19. I was employed at a recruitment agency. I'd seen firsthand where the whole business ended up getting laptops and work from home became a thing very quickly. Microsoft Teams at that time and Zoom got widely adopted overnight, and I was going to be made redundant during that time as well. So come during that time, I was also trying to look for a job, and it took me 3 months to get that next job. But yeah, Hubert, any experience in this area?
Yeah. COVID-19 was I guess that was a big time for me. I guess just the zoo just about started opening. I just got married, so it was just like a huge shift in like everything. They just moved houses, everything. So, I moved in, got to start zoo open, and next thing I'm back at home, working at home. But yeah, it was a tough period. It wasn't easy, but somehow we managed to get through it. I'm sure we can talk more about it later on. But it was definitely interesting experience.
Yeah, great.
I think the challenge was and is as well, which we'll get to, is often businesses probably feel like they're backed into a corner and there's no way out. And, a lot of startups have the luxury of going and raising extra funds or tapping into existing investors, but your mom and pop shops don't really have that. It's either extending themselves on their credit, overextending themselves on their mortgage, or just putting their hand up and actually calling it a day, which is what most are doing. So this is going to be a good episode to go through some of the issues.
Absolutely. Well, what we want to do here is then provide you guys with some practical tips, to think about sort of your revenue diversification, any cost strategies that you may have, and trying to build up those cash reserves to sort of go through this period. So, the businesses that I'd worked for during that time, when we talk about the recruitment area, you're putting out a temporary workforce and you're getting paid on that. So what we were trying to do at that stage was really work around, can the clients actually still maintain those workers going out? But did the clients also have enough profit and cash to pay our bills effectively? So that was really concerning for us, because now you've got a workforce that you're sending out. And if you're going through some unpredictable times, let's say they're factory workers, you got to make sure that your cycle still continues and that the profit to cash gap is not extending each time as well. But secondly, I started also working then sort of into the sort of first phase of COVID, was into bingo skip bins. And basically what they were going through was largely how to make sure you've got enough of a cost base while your revenue is still coming through. So if you still think about it, construction was still going on during that time. So people are still building houses. You still had traders going out. There's still waste being produced. And now you've got multiple sites fighting for that same waste. So you're getting cost reduction elements straight away, or price wars, I should actually say. So now you've got an area of what do you do with your workforce? How do you actually control that revenue? And then where do you sort of get your key account customers as well going on? So there's some really interesting times just to see that going ahead.
Yeah, it was interesting because, like I said, we just opened in December 19. So COVID hit us straight away. Yeah, I mean, I guess something, we sort of built our zoo on the back of international tourists, and for that to be cut off straight away meant that there was a target market was already out of the picture. So we had to focus on the domestic market, and at the same time also do the times where we were locked down, we couldn't close the zoo because there's still a lot of it's all animals still there. So it was just we had to rely on like what Kevin said before, like, at least from my point of view, we had a few investors in there who were able to help us out. We had a bit of, I think, because we were a big tourist, what do you call it, attraction. The government did help us out a bit with that as well to keep us running while we were locked down. And we just managed to somehow get through it. I think, I don't know if you guys remember those JobSaver, job assistance, those schemes they had. That they helped quite a bit as well back then. And managed to get through it. And then, when we came out of lockdown, it was all that, they eased the number of people you could allow into attractions. So that sort of got us in little by little. But yeah, it was definitely a tough period, interesting period, a lot of learnings. But yeah, I hope we never see that again. Yeah.
Did you have to adjust your forecast and your budget? Because you said day one,
Absolutely.
pretty much it hit. So how did you take that approach? Because you've got so many uncertain or unknown variables at this time, right? So what approach did you have to take?
Yeah, it was one of the things we just had to guess what we thought would be a reasonable, percent of a normal attendance. But then instead that we never had a normal attendance to work off as well. I think this is probably our first financial year where we've probably going through what do you call a normal year, where it's at least disruption as possible. So we still haven't had a normal year yet. So it was definitely difficult to forecast, to budget, that kind of stuff. So, but yeah, we'll see. I mean, even like I said, since we opened, there's been disaster after disaster. So once COVID was over, then the economic disaster happened with all the interest rates going up. So we still haven't really hit a proper smooth year yet. So definitely tough.
Yeah, and I think the tough thing for Sydney Zoo as well, tourism market, but in an area which wasn't known for tourism, like outside of whatever it's called now, Wet and Wild or Raging Waters or something, I think it's called. But they had to build like a footprint. I think one of the things, and this is something that I was thinking about when reading through this, when there's times of economic downturn, what businesses tend to always think of is, where can I get more money or where can I cut costs? But instead of one thing Sydney Zoo did pretty well, which I was kind of critical at the start of them for, Hubert probably won't like me saying this, is I felt they built their IP pretty well in the area during that period. They built their brand, their what they're known for. At the start, they didn't do that as well, but I felt like over the last 2 years, especially as the market's pretty flat, they've started to put themselves out there and become the zoo of Sydney. And you can see that now filtering through to celebrities visiting it, continually talk about, we were talking about Candace Owens the other day mentioning it. And that doesn't come just because they sat on their hands and thought about what other revenue streams or what other costs can we cut. They've actively gone and tried to build a personal zoo brand, that intangible asset we talk about. They've actively built that during this time. And sometimes that's the best thing you can do as a business. You can kind of flatline everything and just keep the lights on, but do all this other stuff to capitalize on when the market rises again. So yeah, full marks for that, Hubert. I know you were in charge of that.
No, mate, that's not my department. So.
Mate, you pay the invoices, bro. So
that's right. That's the main part, right? People don't get paid; they're not coming, right?
Yeah.
So Ash, you were talking about professional services, and I think you've been in construction and even in waste. What's something that I guess those industries have done during these times? Like, have they added different revenue streams? Have you had to sit down and look at what's profitable, what's draining your costs, what's draining your cash? Like, have you had to go through those exercises with those businesses?
Yeah, it's a combination, right? So the first one was where's pretty much the costs being spent at this stage, and a lot of it was headcount at that time. And so the business at that time, they weren't prepared to let go of their staff. So what they did as a strategy was sort of stand people down, and what that meant was you'd sort of go full-time hours. You'd sort of go, let's say, 4 days a week or 3 days a week, and you'd be unpaid for that too. So you just sort of ease up that sort of employee cost area. So that was one area. And the second area was looking at for the consistency of revenue and whether or not we could actually help out the customers as well. So at that time, it wasn't about jacking up the price. It was about going, hey, this is the market, we want to help you guys out, keep bringing the waste in, and let's just try to work together and really work with your suppliers as well. So it was definitely a two-way channel, because I think like at that time
See,
it just started. Yeah,
that's good because that's that intangible stuff, right?
yeah,
You're building trust in the market during that period, and you know that
absolutely.
when times get better, you're hoping that customers retain that loyalty with you. So that's good. Yeah. Sorry, keep
Yeah.
going.
No. Then that was the main thing, and then like basically they came around to just modeling how like where things are going, right? So did we need to run all the sites at full capacity the whole time? Once we saw the numbers come through for like a week, we could actually start doing the analysis very quickly, going, actually, it's not needed, right? We don't need to have a 24-hour shift rotation. We could probably do this in like, you know, under a 10-hour shift to, get rid of the waste that quickly and process it all. So it just became time about optimizing at that time. It wasn't about diversifying. But when we start getting stockpiles of products, let's say bags of mulch, then you can start offering those customers saying, hey, do you want a few tons of mulch or whatever it is? Or, if you're ordering a skip bin, you're doing some landscaping, do you want some extra materials? Do you need some sand that goes with it? And that's how we started offloading some additional products. So it was a good
Nice,
time,
man.
actually. Yeah,
I didn't know you guys sold mulch, bro. I would have hit you up for a discount code.
absolutely. So what's some of the examples that you had there, Kev, when you were going through this area? You were in professional services at the time?
Yeah. So a couple of things. I mean, I'm trying to think which industry to start off with first. So construction, the one that I'm in now, the one thing we did kind of last year was open our books. We did the exercise of looking at where we're draining our cash. Very simply, first it was what's draining our cash, and we found out that some suppliers, two of our biggest customers, were paying late. That was putting a drain on our cash. Some of our suppliers, there were delays with getting products from them, which meant that our customers were paying late. And so we had to kind of fix our internal supply chain. The second thing was kind of looking at costs overall, because we knew we needed these big costs in our business, like traffic control and boring and all of these other types of subcontractor activities. And so we looked at tendering opportunities of bulk work. Instead of going to all these different suppliers, we wanted to give it to one supplier to say, hey, if you give us your best rate, we'll just go with you, to try and cut that down by 20-25%. And the other last thing was just looking at our pipeline. So this is, I guess, the same for every industry, but despite how tough things are now, you need to have a good gauge on your pipeline of work or projected revenue. And through that, you can then make decisions on, cost cutting or pivoting. And, we looked at our pipeline, we realized it wasn't super strong, had to make a decision to, let a few people go, which was unfortunate. But again, these are really important business decisions we need to take earlier, rather than going down the track and realizing, oh crap, it's too late for that. So, we kind of had to go through that exercise over a week or so. And I think, a lot of businesses would probably be doing that right now as well, because 2025, despite, interest rates looking likely to get dropped, there's still a lot of uncertainty in the air. I don't know if you guys have that in your businesses as well, but it's meant to be like this period of hope, right? Or maybe I'm just watching the American news, but it's meant to be like this upturn in everything. But I still feel like Aussie businesses have a sense of, defeatism. Do you guys feel that as well?
Yeah, absolutely on this end. So, going through multiple restructures, trying to align the cost base to the revenue, organizations, trying to streamline processes where possible. But yeah, largely, I think I've seen a lot of companies that they're tightening all their like areas now just to make sure they're optimized and they're ready for that next downturn. So I think it's going to get a bit worse before it gets better, but everyone's like, with COVID, especially, like considering it wasn't that long ago, a lot of companies were slow to react. I think this time around they're being a bit more proactive with that approach. So,
Yeah.
Yeah, because the one thing I also noticed is, I guess, being an attraction business, I think most attractions will agree with this. Once the interest rates start coming down again and people have a bit more discretionary spending money, we'll definitely upturn on spending in attractions. So we're looking forward to that part when hopefully interest rates come down again and people start spending. So we're looking forward to that part.
that was an interesting thing because, like, when I was at my dentist, I was at Lane Cove at that time, but I was going to my dentist to get a checkup, and because no one could take holidays at the time when you're saying about attractions, the dentist is saying everyone's just coming in to get cosmetic work done, right? Because they saved up all this money all year. They need to spend it on something. They're like, all right, let's get my teeth straightened or whitened or whatever it is. So, like, the dentists are really busy, not doing cleans or regular, but just all cosmetic stuff after, because people just had that discretionary funds to spend now, right? So, just interesting how that
You said it,
pivots over time.
and the interesting was that, because I said we sort of focused the business on the international market, but because the domestic market couldn't travel as well, I think that sort of helped us in a way that at least the domestic market needed somewhere to go, and we were one of the options, something new, something that they want to try out. So that sort of helped us a bit as well. So you're right, like people had money saved up which they couldn't travel overseas with, so they had to find somewhere to spend it. And and whoever, if you just, I mean, a lot of people lost their jobs and stuff as well, but whoever had money needed something to do, and the zoo was like an option at that time as well.
Absolutely.
Do you guys feel like during these times there's obviously a people impact, right? Like not just people losing jobs, but also there's a lot of uncertainty within your businesses where everyone's like, crap, what's going to happen? Tell me about types of leaders you guys have dealt with in these situations. You don't name names, obviously, because we don't want to get sued. But tell me about good and bad personality traits in these situations.
Ooh. The ones who don't give good communication. What I mean by that is just being open and transparent, right? If there's unknowns, there's unknowns. Just be open about it. Don't pretend like everything's hunky dory on the other side. So I think open, authentic style. What didn't work was the micromanagers and just telling staff just keep your head down and everything's fine, when you could see things weren't, and not addressing people as humans. So just numbers, right? Because everyone's going through their own circumstances. So, like I had to learn that, the one size does not fit all for everybody. So, how you approach people, you don't know their circumstances either, because generally in a work context, you know someone limited about their background, but, if everyone's going through that change, right? COVID hit everyone in this case. A global financial crisis hit everyone. So it's impacting people, like interest rates are impacting everyone, right? You got families with mortgages, you got individuals, you got, people that got large expenses coming through. So, give them the decency just to let them talk if they want to, have that open communication. If they do have concerns and you can answer it. If you can't, just be open about it. Yeah. How about yourself, Hubert?
Yeah, agree. I think what I liked was the open communication, because it's one of those situations where hiding the truth is just going to hurt everyone. So you might as well just say it as it is. Say you don't know what's going to happen as well. And I think that's what I liked about it, where I think everyone was sort of vulnerable about it, and we sort of and by being open, because I remember at the time, even though we were all at home, every week there'd be like all the staff would catch up, like an online meeting, get a bit of update of what's happening. So it was nice to sort of, they were actually very open, and I really enjoyed that. Like sort of, you knew what was happening behind the scenes, and that helped, definitely helped, especially keeping morale around the staff. It helped.
And what's been your exposure then, Kev, to that?
I mean, I agree with everything that you guys said. I think it's important. I've seen leaders that deal with the pressure from above them and kind of push that down as well. Like we talk about the human impact, even the executives and even the managers are under that same pressure. And sometimes it's hard for everyone in the business to see that same thing, because the narrative is, oh, you're on so much money, why would you be under that pressure? And I think it's good for that empathy. But I think for the leaders especially, they take that pressure from above them, which is, their executive team or their board or whatever, and they nail that down, like you said, Ash, onto the team below them. I think there needs to be an extra level of empathy to people in teams that, I wouldn't say are bottom of the chain, but the people that are on, sub 60, 70, 80K salaries, they, like everyone else, will struggle, but they're the ones that are usually going to feel the biggest hurt out of it, particularly in environments like this, because then you go into the job market and, there's millions of that same talent, particularly with immigrants and stuff coming into the country. So I think that extra level of empathy needs to be had, which I've seen not had. I remember in one of the scenarios over the last year and a half, one of the executive members was walking on the floor, and everyone was talking about, oh, what's going to happen? The business might go bust, business might get sold. Everyone's really worried. And they asked the executive guy, and he went the other way. He was like, I don't care. I've got my house paid off, for whatever happens. We'll just all have to deal with it. And one of the guy, when he left, was like, well, we have to deal with it. I've got a freaking $1 million mortgage I'm trying to pay off. Mm-hmm. And so I just saw the massive disconnect, because there's now, you can put all the pain onto your team, or you can go the other way and say, well, who cares, kind of thing, but you got to realize the real human impact, like you guys said. So that's I think it's important to not be self-centered during situations like this.
Well, it's even that leadership to be realistic with, if we're saying that sort of that mid layer, leaders, and they're going up to ELT as an example, don't commit to numbers, you can't literally deliver on. If you're going through a financial crisis, or you're going through interest rate spikes, don't commit to hey, this is going to be our best year for profit, and we'll cut all these heads to make it work. Terrible, right? You might make it work for that 1 year, and then you'll drain your business straight after, right? And that's what you see. Everyone's so focused on closing out whatever period they have by just making the numbers work, that they're not even seeing 2 or 3 months into the future. And then 2 or 3 months, when we're in it, we're like, why are we in this spot? Oh yeah, we took all those heads out. They're the ones that we actually really needed, and they're gone now. The pipeline's gone, as you explained. Now the business is in a much worse position, because we were so short-term focus. It's pure madness.
And why do they do that? You always think about drivers, right? Why do people miscommunicate results? There's always a deeper driver in there. It's either their short-term incentive, or there's trying to keep yourself in a job for a couple more months, or you're just trying to get everyone off your back. And that's where there's a holistic accountability for things like that. Yeah. It's easy to blame the one person in charge of those numbers, but also it's, why have you set up your short-term incentive in a way that encourages people to, so everyone's got to take ownership for something, especially during situations like that. So yeah, it's a hard one, but good for big and small businesses to think about these situations.
Yeah, absolutely. For a big or a small business, if you're just trying to close out your number just for the year, and it means you're gonna have to sacrifice a few things that you probably shouldn't have. Just double think it, because if you sometimes hack the wrong parts of the business, you may not have business to come back to in a few months, right? Because they're the ones that were keeping you afloat, or whatever it is, right? So, and I spoke a few episodes ago about that, profitability of clients, check, because you need to have that. Ideally, sort of have that constant revenue that comes through. It might not be great margins, high risk, high reward. It may just be low risk, low reward, but at least that keeps you afloat throughout these economic downturns. And then you have that high risk, high reward stuff. But in economic downturns, those pieces of work do not exist anymore, right? Because there's no money to spend. So really balance it out, and have that balance of where you can have, when times are good and when times are bad, at least you can sort of keep afloat. By just coming back and doing a poor analysis here, but going, so we're all high value, high risk, high reward. We don't want to do that low value stuff. We have no capacity. When interest rates go up, or there's this tightening of the market, once those projects dry up, you've got no pipeline, as Kev explained. You've got no work, and then you'll be in a similar situation where Hubert, you're trying to predict something that can't be predicted. You've got zero variables to play with. If you've got no customers coming in, there's no new money into the business. What happens? And it's because you made some really short-term decisions, going, oh, we can transform the business, make not 10% margins, we can go to 30% overnight, right? Doesn't happen.
Yeah, it's a great point. I don't know if you guys follow the Secret CFO LinkedIn, Twitter page. He's just basically CFO, and you in America or Europe, he's a listed CFO. No one knows who he is, but he provides advice and analysis and stuff. And he's done a really good one on Peloton, which I recommend that you guys read. Ultimately, it's spoken about the failure of their business model, how they've failed to see the projections, which Ash was talking about, but now how they've had to refinance their debt equity structure to support the sustainable running of the business into the future. And obviously Peloton's a massive business that had massive hype on it, but it's really good to just see a case study like that, and he's done it over a couple of weeks. So if you guys haven't read it, I recommend you kind of go through it. But it gives you exactly all the stuff that we've been talking about on steroids for a massive multinational business.
And that CFO is Kevin Sampath.
So I got a question for both of you. Now we're talking short-term goals for these businesses, right? Like people, like when it comes to, and I'm sure a lot of our viewers might even think about this, like when you're setting up bonus structures for your staff, because some businesses have very short-term, and like this in this financial year hit this profit target, whatever it is, and you get a bonus. That can incentivize people to really, cause short-term decisions which benefit themselves but not the business. So how would you go ahead with like setting up bonuses for staff to do what's best for the business, but also being achievable for them to hit that target sort of thing, something they can achieve that can get them a bonus?
I guess when we've done this before, every time we've designed bonuses, we think about the drivers where people can misuse it. So a small one in professional services, recruitment, right, was accrued revenue. Like people will say, place this candidate, accrue the revenue for me. It'll be like accrue. So we know the risks there, and you need to create controls around how they can misuse it. And obviously, if there's things you don't see and that gets misused, you need to kind of try and pick that up proactively. But like that seeing that in professional services, you knew that was a risk. So you create controls around what can and can't be accrued. Like, you need written acceptance after like a couple of weeks, essentially, even if the candidate has started and there's no money coming in, then that money's gone. But you want to be able to mitigate it even before that, because we've got strict client terms and things like that. So it's looking at, for me, when I'm setting up short-term incentives, it's how can people misuse this? What are the dangers of that for the business? And what controls can we set up around it? And there's also like a human element. It's sitting down in front of the person, the executives, talking them through it, seeing where their eyes light up. And that's when you're like, all right, crap, I've missed something. I need to go back and do my homework on things that they could misuse it. Like even in construction, I'll tell you guys, I might edit this out, but I've seen a story, not in my business, of a sale of a particular business to the wider parent company, and they had an incentive, like an earnout incentive. And looking through the historic records, they obviously met the earnout, but just so how it happened, the year after, the business was run into the ground. And people will say, oh, it's because the customers left, because the leader left, or because there's all this staff that left. But actually, it was poor controls during that earnout period, because they couldn't actually pick up the issues. And because they didn't have those controls, because they didn't have those red flags set in, they hit the earnout, got all the money, ran away, controls fell to the ground, but there were no controls. And so the real state of the business was exposed. So yeah, it shows the importance of, I guess, financial control.
Oh, 100%. Yeah, like Hubert, it's a great point. I think, going back to the drivers of the organization. So as an example, if it's services or if it's a product, for me, always come back to like profit to cash cap, right? So make sure the money's in the bank before you pay out a commission. As an example, you don't want to jeopardize the brand, like reputation. So whether or not how you measure that, it could be through like profit margins. So you don't want people to like tank the price just so they can get the revenue target up, because that's one of their balances as well. So really get something inside there, and then some sort of measure on is it NPS equivalent, like for customer satisfaction, and some of those are a bit biased, but what you want is to make sure that you can still go back to that customer again and do some more work with them, right? You don't want to have a one-off transaction and have a really poor experience, because then something else needs to be factored in, right? So you want them to, your employees to represent the brand, the good stuff they're doing, and for the brand to actually go, yeah, we're a quality organization, whatever service or product we're offering, continue to work with us. And, it should be a two-way relationship there. So they're the things I'd be structuring that. The higher up you go, the more longer-term things I'd want to see in play there. So I wouldn't just go, hey, you've met this year's profit target, but it's okay, you've set up this structure. What's next year look like? What's the year after that look like? So a bit longer term, and they get more complicated. What I don't like to see with commission structures is when you're making up random assumptions, like, whatever they've Googled or heard from a colleague or went to a forum and they're like, oh, wouldn't it be great if we could have, ChatGPT do this, and if we got that and multiplied our revenue by 100 times EBITDA X, and put that in Bitcoin, oh yeah, you get all your bonus. Like something really just bizarre that you can't measure, right? You can't measure it, don't bother putting it in, right? And if whoever's making that commission scheme can't measure it themselves, there's a problem, right? It shouldn't ever be like, oh yeah, you provide me with your evidence so I can pay your bonus, right? That's ridiculous. It needs to be measured back to the basics. How about
What's
yourself,
your
Hubert?
view?
Yeah.
What's your view on? Sorry, you go, Hubert. I want to ask you a follow-up question.
No, go for it. Oh,
Well, my follow-up question is, I think a lot of these short-term incentives, and this is probably me being bitter as an accountant growing up, but I think it needs to translate to if not the entire team, at least elements of important people in the team that roll up to. So there's a shared sense of ownership, but also accountability. In that way, like it's not just one person manipulating the numbers. It has to be like a whole team colluding. And if that's the case, then there's obviously a cultural issue in your business. But if there is a shared ownership and accountability of a number or a particular target, or how that short-term incentive is being calculated, then I just see that as a win, net positive for the business, because everyone is on that same journey. Everyone is collectively growing. And if your leader chooses to leave, the people that sit beneath them also understand how that leadership structure works and what the drivers of the business are. And this is one of my biggest criticisms of short-term incentives, that it sits at that manager or exec or even higher level. Is I get that they make all the big decisions and they're ultimately accountable for the performance of the business, but there's no sense of shared ownership and accountability across the rest of your teams or business. And there's no, I forgot what the term is called, succession planning off the back of those leaders leaving, because the next person that comes in is just going to be fresh-eyed. She's going to be like, oh, I'm going to try and maximize this to the full for myself. But if you're training that culture in, then there's a shared ownership in the business. But I don't know, maybe that's just idealistic speaking. What do you guys think?
I've seen a global profit share in place with one of the companies I work for.
I remember you saying,
and
that's actually really good.
Worked a treat, right? Because everyone's on it now, right? So all your employees, so from like your finance team to the engineers, to everyone, that worked great, because now it was never like an us versus them type of situation. It was like, hey, you're doing a project, we're here to help, because we've got skin in the game too, right? Like everyone's got it. So like now you're creating an environment where everyone wants to help each other, not just, like you saw the normal sort of conflicts at work, but everyone's got that same vision in place now because you've directly correlated it, which works. I've not seen that anywhere else, and it still blows my mind. Why? And it's a very simple concept actually, if you think about it, right? So, and I've never seen a place where everyone is so aligned on the one thing. And helping each other out and cross collaboration. It's always like now you go to workplaces, it's like, oh no, why am I getting a request from that person? Can't they do this and can't they do that themselves? Or that's not my job. I'm like, relax, guys. Like you're here to make a difference in whatever you're doing, right? Like, yeah. So
do they have at different levels additional stuff on top of that?
So that you got like almost like, let's say based on tenure and role, you'll have a certain a higher portion compared to, like, let's say a junior engineer, right? So, so the higher up you go, you get a bigger chunk of it. So they do weight it. But yeah, it's relatively transparent. Like they give you sort of a guide. They tell you how much profit they made globally as well. So it's not even just like, hey, Australia, I'm going to focus on my market. It's globally, everyone needs to do work. And like, well, so what that means is, like, Australia, you're now willing to help a counterpart to make sure that they succeed if they need to get, a project across or whatever it is, or can you, share skills. Completely different environment, right? Right now, there's, I've worked for global companies where I have zero understanding of whatever the other country is doing, right? I don't even know their headcounts. You might see a leader's name pop up every so often. I'm like, that's meaningless to me, right? So, yeah. How about your guys' experience?
Hubert, how's your short-term incentive at the zoo?
Well, I mean, I don't think. Well, I guess this is where it sort of comes down to when you set a profit target. I guess, and this is what I've seen where people, you can hide a lot of stuff. Where, say, for example, you want to go earnings before income, EBITDA, and depreciation, tax. You see a lot of people start capitalizing assets, instead of expensing it. So you're sort of hiding numbers, and then that it sort of gives a false sense of what the actual how the business is going. And I think Ash's point as well, like say for example, this year you want to hit a certain profit number, just sack a few employees. Profit looks good, short term, great, but then you're pretty much ruining the business in the next financial year. So that's the sort of that's sort of my sort of question around bonuses, whether it's actually works or not, like, and because you both come with good points where you can sort of control it, but yeah, that's sort of where bonuses can be dangerous, where you can, employees, someone can just look after themselves, like, look, I hit this target, I get a decent bonus, but yeah, so that's why, like, especially for small businesses, viewers out there watching, like, when you come and you want to incentivize employees, how do you do that the best way?
I think that's what makes your role really important as well, Hubert. Like, that's where the finance leader kind of should add that critical. You might not always be the most famous person in the room doing that, but that's where your value comes in, right? Because you have that independent call out of things that you don't feel are completely accurate. And ultimately, your business leaders, your CEO kind of makes the ultimate call, but it's your kind of job to be the bad boy. Good cop, bad cop, so to speak.
Yeah.
And I know you like being bad cop.
Well played.
But yeah, it's hard. Cool. We've kind of gone on multiple tangents there, but I think they're all pretty useful.
We started with economic downturns, going through COVID, explained some of the strategies like forecasting that that needs to adjust. So in Hubert's case with the zoo, then we sort of went back into like pivoting where businesses like needed to diversify or look at their cost strategies, and then finally we started looking at sort of like leadership during that time, right? So what that meant, and then finally commissions, does it work? So like it's all got very important areas to play, and like each one, almost think of it like a link, right? That's why it's gone into a tangent, this conversation, but each link has gone onto another link, and we're just going, actually, what else happened during those economic downturns? What was important? What worked? What didn't? So, and the importance of just finance people throughout. I think it's easy enough just to do that spreadsheet and that forecast. But, when you're working very closely with those leaders in the business and trying to figure out people, you can really work out very quickly sometimes something may make sense on paper, but it's not the right decision, right? And as a trusted finance professional, you need to connect those dots. And you need to connect those dots because you've got that background and you've got the right people around you come back and say, hey, look, on paper, this makes sense, but we need to just pause, zoom out, chat to everyone. Yeah, we'll make the numbers this year, but next year we're going to lead ourselves into serious trouble. Let's not take that decision, right? So, yeah, it was a really wide and good overall, pod. So, thanks, guys.
Good chat. If your business is in trouble or looking to get out of trouble,
contact Hubert for some pixelation.
contact Hubert if you want him to sit in your boardroom and tell the senior leaders that they're manipulating the system.
Bonuses do not work. Good times. All right, Kev,
Cool.
Was there a like and subscribe?
Yeah. Make sure, guys, that if you're listening, you like this content, like, subscribe, comment on things that you want to hear, or even just message us, talk to us about it. We love championing Australian business and helping Australian businesses thrive. Obviously, very tough climate at this stage, but anything we can do to help, we are here for, even if you want us to take a look under the hood and help you guys out. Like, subscribe, follow, do it all. Thank you for listening.
And there's a new newsletter, right, Kev?
There is a new newsletter.
What's that
called? Summarizes the contents of what we chat about. It's called Cashflow Cafe.
Epic.
It was either that or Cash Me Outside. How about that? I had to go with something a bit more mature. But it's essentially summarizes. So this conversation we've had today, we'll have a nice, neat summary of that in the newsletter. Obviously, not to the depth of content that we've spoken about, but gives you a good summary if you don't have the 30 minutes to listen to this and you just want to skim over some of the hot topics. Subscribe to that as well. Catch you guys. Thanks for listening.